Hey everyone, welcome back. This is Jim Cosmas with Snowball Industries. Have you ever heard the term what gets measured, what gets tracked, gets improved? Today we're going to talk about the things that we should be measuring, the things we should be tracking. We're going to discuss KPIs for performance and KPIs for your financials. So when we talk about financials and we talk about performance and we talk about kind of minimum standards and KPIs that we need to achieve, it's best to have a benchmark where you can look at what is typical for companies around the country that are achieving a specific profitability. And then you can look at what you are currently doing and put in some numbers there just to see how you measure up, and also to be able to see where you can improve. Again, what gets measured, what gets tracked, gets improved. So we've created a KPI benchmarking tool for you here at Snowball. I will share my screen. I'll go over with you the benchmarking tool, how it operates, and the different features of the benchmarking tool. So what you're looking here at right now is the KPI benchmarking tool. And it comes in several different kind of categories. And you can see at the tabs here at the bottom, we have one for HVAC service and maintenance. We have one for HVAC replacement. We have one for plumbing. This is plumbing as a whole, electrical as a whole as well. And then we have a separate tab just for overhead. And then we have another tab that's called revenue per head, which I'll explain in detail when we get there. So we'll look at the HVAC service maintenance right now. So you will need to have some data. You're going to need to have some data from your financials, and you're also going to need to have some data from however you're tracking performance benchmarks, we'll get to in just a moment. So don't need that data right away. I will begin by doing a mock company just to show you how the tool operates and some of the features of it. Everything is broken down in different sections, and here we start with direct costs, and there are tons of debates on what goes in direct costs. So this tool is broken down on what we know should go into direct costs, and we've listed them here. So for HVAC service and maintenance, you have a materials section here, and we're saying the benchmark is at 11%. So anything you see in blue is where data gets entered. So blue means required information. Anything you see here in this light green means that this is a result. And if it's green, it's a good result. You see here, if it's red, that means there's room for improvement. So we will start with the blue, and materials benchmark is 11%. We'll say this particular company is having materials at 13%. Now, what you will notice is this cell turned blue, the result turned red rather. And the reason it turned red is because you are 2% over the benchmark. Now, it doesn't mean that we're going to go into panic mode or we have to make some massive changes. It's just a kind of a reminder here, and that says to you, I've exceeded national average benchmark. I've exceeded it in this case by 2%. So when I see this red, it tells me that there is room for improvement. Had I put exactly 11% where the benchmark is, you would see it. I don't need to really do anything on improvement, and it stays green. So again, purposes of this exercise, we'll say 13%. Total field labor, and that's fully burdened, which means all of your taxes, all of your benefits, all of your insurance, all of that should be somewhere about 25%. So if we have an actual here, let's just say we are actually at 25%. You will see this goes to 0. I don't need to really be concerned about it. I'm at the benchmark. Permits on HVAC service and maintenance should be 0, right? There's no reason to take out a permit. Now, when we talk about permits, we're talking about permits associated with a job. So if in air conditioning, if I'm going to replace heating and air, I may need to take a permit. Electrical, if I'm going to replace a panel or install a generator, I'm going to need to take out a permit, and so on. But permits here should be 0. Rentals, if I'm going to rent equipment for service, usually don't have to rent equipment for residential service. However, if you do have to rent equipment, this is where you would put it in here. Typically, it's going to be at 0, but just for the purposes of this exercise, we're going to say we're at 0.05. Again, this will turn red, which indicates that there's some room for improvement here compared to the national average benchmark. Warranty reserve. Typically, service, we don't have a warranty reserve percentage in there. That's really more reserved for big ticket items, replacements, and things of that nature. So that should remain 0. Extended warranty, same kind of thing. For service, should read 0. Finance buy down and fees, right? So this is when you're offering financing. And most of the time we offer financing on big ticket items, replacements. But offering financing on service is an absolute must. And depending on the finance company that you deal with, they will finance you some as low as like $400, depending on the type of finance company you deal with. So here we're saying that the financing should be at 0.5%. If we're financing at that, we're going to say we are at, we said 50% here, so you have to put 0.50. Okay, that'll be the 0.5%, same like our benchmark. And subcontractors, typically for service, we're not using subcontractors. That should always be 0. And sales expense, this is for sales staff only, sales expense and commissions. So if we have sales staff that sells, not selling techs, but sales staff that sells service, then 1% should be it. If we don't have sales staff that sells, then don't worry about it. If you do, if you're going over that, let's just say 2%, you will see again the cell turns red, which means that we have to look at this. This is just a flag. And total cost of goods, okay? All of these encompass all of your cost of goods. Now, you may enter more things. You may have other things in your cost of goods. That's why we left this cell for you to actually fill in and not just calculate. So if your cost of goods, we're saying for service should be at 38%, we'll put it at 38%. And what'll happen is it will calculate your total gross margin, right? So 100 minus 38% leaves 62%, which means that we have 62% available to pay overhead and other things and to take net profit from. So had our direct costs been higher than 38%, let's just say 40%, again, remember, this is for service. The cell will turn red. That means there's a red flag here. There's room for improvement. We've exceeded the national benchmark. So that's why it turned red. And you will also see that your gross margin has now fallen below national benchmark. And that also turned red. So this gives you an indication as to where you can make improvements and where you have some challenges in your organization. Profitability benchmarks. We want our service department, typically, at least in HVAC, to represent approximately 25% of our revenues, okay? If it does so, we're going to be in the green. If we exceed 25%, we're probably going to go into the red, as you see here. That means our percentage of revenue from service to replacements might be a little high, and it's something to take a look at. Same thing if we fall below. So accounts receivable for residential service, this should always be 0. There's just no negotiating. It should always be 0. However, if yours is not, and it's higher than that, I put $10,000 in here, you will see that that cell turned red, but it should always be 0 because in residential service, you should be COD whenever possible. I understand every once in a while you're dealing with a tenant landlord scenario, or you're dealing with markets where you have rental properties or vacation properties. You may end up running up a receivables, but that should be, I mean, that's the exception, not the rule. And your net profit on service. This is service and maintenance. That means the repairs, the demand calls, the maintenance calls, those sorts of things. We're looking at national average of 26%. If you fall above that, great. Like if you fell at 28%, you'll see you're doing 2% above, the cell is green. That's great. If you fell below that, you're doing 2% below and the cell turned red. It means that there's some room for improvement there. And now performance benchmarks. And this is where we get asked often, like, where should we be on performance? So for a client service hero, CSR, we're looking at for inbound call conversion rate. In other words, for every inbound call that comes, how many of them are we saying is a good benchmark? Should they convert? We're saying 87%. So if they're converting fewer than 87%, we'll put 85. The cell here is red. Now these default to red because there's nothing in here presently, so they will change as you move along. But if we're at below the benchmark, that will default to red and tell you you have a 2% improvement here that should be made. Dispatch hero, number of service calls per day per technician. We're saying a good benchmark is 4. We don't want to exceed 4 calls. If we're sending technicians out on 5 or 6 calls, you will see that will turn red, says you're sending them out on too many calls. If we're sending them out on 4, that's great. If we're sending them out on fewer, that's okay as well. So 4 is the benchmark. That's what we want to achieve, 4 per day per technician. Outbound hero, customer retention, happy calls, quality control. Now, sometimes your CSRs are doing this. Sometimes your dispatchers are doing this. And in some organizations, we have people that are, they're strictly outbound calls. They make outbound calls for quality control, for follow-up, for unclosed leads, those sorts of things. And we're saying outbound calls for customer retention, for happy calls, quality control calls should be 98% or better. All right, so very little room for negotiation here. So if you're only calling on 90% of your clients that you've done service for, you're missing the boat and you have some improvement here. If we're at 98%, excellent. If we're at 100%, excellent. All right, cell will stay green and it tells you you're doing great. Outbound hero, customer retention for unclosed sales follow-ups. In other words, service went out, something wasn't sold, they proposed a repair, and the customer said, I'm not interested, or I'm going to think about it, or it didn't close for whatever reason. There needs to be a follow-up on there. You will find literally hundreds of thousands of dollars if you just did nothing more than followed up on unclosed sales leads and service leads, unclosed service leads. So we're saying 98% of those people should be contacted. I'm saying it should be 100%, but 98% is national average. So we want to contact 98%. If yours is lower, you will see you're going to get that red box, which says there's room for improvement here. Okay. Average service and repair ticket. Again, this is for service HVAC. National average, 425. If yours is higher, great. If yours is lower, it's going to turn red. So 425, it will go green. If yours is higher, it will stay green and say you're doing better by 25 bucks. Great work. If it's lower, it's going to say you need some work to do. You're behind national average. Same thing with average indoor air quality ticket, something that a lot of companies simply don't measure, and we should be measuring that separately. Indoor air quality, especially post-COVID, should be top of mind, and we're looking at $425 average ticket on indoor air quality. Okay, should be, in my opinion, should be twice that. But $425, according to national average, you're doing good. Service hero, conversion rate and close rate on repairs. Okay, so if I'm dispatched out to a service call and there's a repair and I propose several options, several repairs, several solutions, I should be closing 85% or greater. If I'm closing less than 85%, that cell will stay red and says you've got some improvement, 5% to improve. For closing at 85, that cell will turn green. For closing above 85, that cell will remain green and says you're going above the national average, doing great. Again, service hero, maintenance agreement, membership conversion rate. Okay, this is for new memberships. The maintenance agreement, membership conversion rate. So now we're going to talk about our service technicians, talking about membership agreements, maintenance agreements, okay? For new maintenances, not renewals, nothing like that. This is new. We're saying national average, good number to be, 32%. So for every service call that a service technician is dispatched to that is not an agreement customer, they should be converting 32% of those into agreement customers. So if we convert fewer, it's going to stay red. Some work to do. Staying on the service heroes, average maintenance ticket. So for average, every maintenance call they go on, there's going to be an average service ticket on a maintenance call, because as they go through their maintenance, one of the things they should be doing is looking for potential challenges and problems and issues with the system, and then making proposals or estimates or solutions to correct these problems. So average maintenance ticket should be $225. If we're doing that, that's great. Cell will turn green and it'll tell you you're doing well. Callbacks, again, service heroes for callbacks should be 2% or less. If your callbacks are greater, cell's going to turn red. It's going to say you have high callbacks. But 2% is a national average. I'd love to see 0 callbacks, but realistically, that would be a challenge. But 2% is where you want to achieve. All heroes, maintenance agreement, maintenance renewal rate. Why do we say everyone? Because everyone is responsible for maintenance renewals. Your CSRs, your dispatchers, your service staff, your installers, your management, because it's the service that we provide, and it's the excellent customer service that we provide that keeps people renewing their maintenance agreements. So we want a 90% or greater maintenance renewal. Again, this is where you put your actual numbers, okay? So I'm just putting up a mock-up in all these blue boxes of this particular company, actual numbers, comparing them to your benchmark numbers. And then we'll give you a result. So it gives you somewhat of an action plan of where I need to focus. Anywhere I see red boxes, I need to have a level of focus on. Service hero, replacement turnover on repair calls. In other words, I was sent out on a repair call. Something broke. Something's not working. Air conditioning's not working. Technician is dispatched. We get there and the technician discovers that the system is older, or maybe is the repairs far exceed the system's value. So the technician is going to recommend replacement. So that's what we're considering replacement turnovers or replacement leads on repair calls. We're saying 20% of every repair call they go out on should result in a replacement turnover or a lead for either a selling tech to sell or a designated salesperson to sell. 20%. If you're falling below that, box will be red. As you see, box will be red, says we have some work to do here. Service hero replacement turnovers on maintenance calls. Same holds true for maintenance calls. Every time we go out on a maintenance, whether it's a maintenance agreement or just a straight maintenance that somebody's paying for, one-time deal, 10% of those should convert to replacement. So if we're not converting 10% of those to replacement, again, box will turn red. So we're saying here, this company's converting only 5, box stays red, says we have some work to do there. And management heroes. So here's where management needs to manage the utilization of billable hours, okay? The billable efficiency. 60% is a great benchmark. Most companies, however, fall below that, 50% or less. If you can get to 60% billable efficiency, which means for every hour that somebody is working, how many of those hours are we actually billing for? So if a technician puts and works and gets paid for 8 hours, did the technician bill 8 of those hours? Or typically not. That would be 100% billable efficiency. Typically, the directionally correct companies, the ones that are really solid, are at 60% or greater. So if you're at 60% or greater, congratulations. If you're not, put your billable efficiency in here. Again, if you don't have a bill, if you fall below, it will turn red. So here gives you a snapshot of something to measure against. Again, what gets measured, what gets tracked can get improved. So now we have our actuals, we have our national benchmarks, and then we have our red cells that say here where we have some improvements that could be made. And this now also goes to each one of these cells. So if we look at the replacement side, the same sort of thing happens. We put in our numbers for the replacement on HVAC. Plumbing, exactly the same thing. Now, plumbing, we've combined both the replacement and the repairs. We will at some point, once we have better data, start to break replacement and repairs out, but we've combined it totally here. So plumbing, you're looking at benchmarks for your materials and your field labor and so on. Exact same as we just saw. If the boxes turn red, we have improvements to make. If they are green, we know we're doing well there. Electrical, same thing. Now there's a separate tab here strictly for overhead. So when we look at overhead, we're looking at variable and fixed overhead benchmarks. So we're looking at all overhead wages. We're looking at marketing. Overhead wages are now your administrative wages, the office wages, management, owners if they're not in the field. Like this is your overhead wages. Anything that's not direct costs, anything that is not associated with a direct cost wage. So here's where we're saying they should be at 10%. Marketing percentage. Now, what's listed here is 6%. Typically at 6%, you will achieve a 15 to 20% growth year over year. Again, depending on the marketing company you're with and how well they execute. So you will see here, if you can have greater or less. If you fall below 5%, however, and say we're 4%, you're going to see that cell turn red, right? Anything over a 5%, that cell will turn green. So if you're below 4% marketing, you will get a red in that cell. And we typically don't want to get below 4% marketing. Now, again, if you're very well established, been around years and years and years, have high market share, there's an argument to fall below, but typically 5% or greater is where you want to be. 6% will get you 15 to 20% growth. Greater than that, greater growth. Vehicle percentage. This is anything to do with your vehicle costs. 6% is the benchmark. Facilities, all your facility costs, your rent, your building, all of those things, electrical bills, those types of things. 4%. Administrative costs. Now, this is all the other administrative stuff, your pencils, your pens, your computers, like all the other kind of stuff, 10%, and then your total overhead, okay? So this is all of these combined. You may have other things in your overhead. So 36% total overhead. If you go over total overhead of 36%, say you're at 40, again, you will see this box turn red, the same with the others. Profitability benchmarks. Target revenue per head, okay? So this is a concept that says there is a revenue per head number that you need to achieve in order to achieve a level of profitability. Now, revenue per head, I'll show you in the next tab. Revenue per head means how much exactly revenue per head is associated with your company. So if you did $1 million last year, and it took 25 people to do that $1 million, which is a lot. I mean everybody, because everyone has their hand in the revenue. Your people that answer your phones, your dispatchers, your service technicians, your sales staff, your management staff, your warehouse people, they all have a hand one way or another in that revenue. So we do a revenue per head calculation. So in the next tab, we'll show you how that calculation happens so you can fit this or fill this box in. Accounts receivable, again, I don't care which division you're in, what kind of business you're in. If you are in residential services, that should always be 0 with very, very few exceptions. Net profit, we're looking for a minimum net profit of 20% in all of these, minimum net profit of 20%. And then cash reserve, so total cash on hand over, we're saying 90 days. In other words, that you want to have, so there's another a tool that we put together called the daily break-even analysis. If you fill out the daily break-even analysis, that will then also give you that cash on hand or cash reserve. But you should know your cash reserve, and it should be 90 days or greater. And I'll even say that it'll probably be even greater than 90 days moving forward. But 90 days is where you want to be on total cash on hand. So that's basically it for the overhead. Now, revenue per head calculation. Here's what you do for a revenue per head calculation. You will take 12 months of revenue, total revenue for 12 months. So it's best to do that either in a fiscal period or a calendar year and say, okay, this is how much revenue, top line revenue we did in a 12-month calendar year. Or you can do what's called a run rate, which means that I'm going to take the previous 12 months. So I'm going to take last month and then another additional 11 months before that. So either way works. So we're going to put in here just a mock-up. We're going to say this particular company did in the 12-month period $2,357,428. Okay. Now, the number of people that were employed during that time. Now, this means everybody, owners, managers, service techs, installers, apprentices, helpers, warehouse staff, parts runners, CSRs, dispatchers, outbound call, everyone that was employed. And we'll say in this particular case, there were 29 people employed. You will see this box immediately turns red, and it will tell you your total revenue per head per day was $223 in this particular scenario. Now, that 223 doesn't mean much without a benchmark. I'm going to go back to the benchmark of overhead and fill in this 223. Of course, you will also see that that turns red. And it's saying that our benchmark should be 1,370 revenue per head per day. We missed it heavily. So here's basically how the rule of thumb goes. A minimum revenue per head per day of 960 will achieve typically a 12 to 15% net profit. And that's just how the numbers work. If your revenue per head per day is 960 or greater, you will see a 12 to 15% net profit. If your revenue per head per day is 1,370 or greater, you will see an 18 to 20% net profit or higher, right? So the target is 1,370, the minimum is 960. How do we change this? Now we have a lot of things to talk about. Is it because our average ticket is too low? Is it because our billable hourly rate is too low? Is it because we have too many people? And I'll just show you a scenario here. If we had 18 people instead of 29, that goes up to 359, still too low. So it's not always just the amount of people, it's everything else that goes with it. So now we have to scrutinize the rest of these numbers. Are our materials too high? Is our average ticket too low? All of these numbers play a role in the revenue per head per day, which affect your total revenues. So there you have it. This gives you the full KPI benchmarks for both your financials and your KPIs for performance benchmarks based on HVAC, plumbing, and electric. Talks about overhead, and then this critical revenue per head calculation. Of course, if you need some help with any of this, feel free to give us a shout here at Snowball, and we'll see you soon. Have a great day.